What's up, traders? Andrew O'Connell here with Pristine Capital. Welcome to your market recap video. It is October 4th of 2022. We had another bear market barbecue, team. Let's take a look at these indices. They're doing what no one believed they could do, team. The S&P 500 finished up 3.1%. We had our NASDAQ QQQ finishing up 3.14%. The IWM small caps showing some nice strength at 3.96%. Our dogs of the Dow were laggards today, up 2.83%. And our ARK Innovation ETF, which was a laggard yesterday, was the leader today. It was up 7.63% in a single session. Pretty much all of these indices, they closed towards pretty much right on the highs for all of them. Volatility did contract in most of these indices aside from the Dow Jones. But I will note that it is very odd that the S&P 500 was up 3.1% and the VIX was only down 3.42%. Normally, this would be a much bigger decline. So that is definitely good to see that it's declining, but I would call this a bit of a divergence. Definitely just something to keep an eye on for the rest of the week. We had very strong small cap breadth at 94% advancers. Overall up volume was 96.2%. And the trend model remains at a +1 reading. And I see all these narratives out there, all these headlines, all these different, worlds everyone is building. Oh my gosh, the future is going to look like this. This is going to happen in the bear market, and then that's going to happen. And to be honest, I found it works better just relying on the trend model and just doing it that way. A lot of times it helps when you just have fewer inputs to your process. That is always good, and especially too when you have defined setups, because then you can just look through the market and go, are the setups that I like here? And if they're not there, then it's like that will tell you whether or not to be invested in the market. Take a look here. We had, for today's economic data, of course, we had a bunch of Fed speakers. Then we had our JOLTS job openings. You can see there were 10.053 million job openings. The consensus was 10.775 million. And the market did end up really just continuing the rally when that number came out. Some people are saying like, oh, it spurred a rally. But to be honest, like when you have positioning as washed out as it was, we mentioned this in our weekend video saying like, hey, positioning is lower than what it was at the bottom of the COVID crash. So if you're looking at that objectively, it doesn't really take even good news to get a rally off that. All it takes is just like some not horrible news, and you can really get a pretty big rally. Our factory orders month over month for August also came out. The consensus was 0%. They did come out flat at 0%. Remember, the theme has been good news is bad news and bad news is good news in terms of economic data. Tomorrow for Wednesday, we do have these ADP employment numbers coming out. The ADP, it's very interesting. Like the correlation between this one and the non-farm payrolls data that's coming out on Friday. NFP is what everyone in the bond market's looking for. The fixed income market definitely trades off it, equities, etc. This ADP number, it could definitely move the market tomorrow. But I found like the ADP number gives you no indication as to what the NFP number is going to look like. They must be calculated in different ways. This indicator, it's kind of like laughable, just like how bad it is at predicting the NFP. But to be honest, like the market's so volatile, the VIX is still so high. Investors are still very jittery. So I would imagine we are going to see some pre-market movement based off of this ADP number. Again, I would imagine if the unemployment data or the employment data looks weak, the market will perceive that positively. Perhaps the dollar goes down, perhaps bonds rally, that sort of thing. If this comes out very strong, we could have the other reaction where perhaps the dollar rallies, perhaps bonds sell off, and that's really the unhappy path for equities that have just had a really nice 2-day bounce. We also have our S&P Global Composite PMI. That's coming out at 9:45 a.m. We have ISM non-manufacturing PMIs. And again, I think it's going to be bad news is good news and vice versa. And we have one speaker in the afternoon. Our VIX Futures term structure is definitely becoming more flat, but it is still slightly inverted. This darker line here, this black one, this was yesterday's data at the close, and then the blue line is today at the close. And it looks like, oh my gosh, like all these VIX futures term contracts really dropped huge. But the scale on the side here, you got to pay attention to it. It's really just the bottom is 28.5 for, whichever VIX future. The top is 30.5. So you can see the front month VIX future dropped from about 30 to 28.85. So, take that for what it's worth. But you can see that front month VIX futures contract, it's still just a smidge higher than the November month. And the November month is still just a smidge higher than December. And you can see once we get into that new year, then the term structure really takes a jump higher. So yeah, that is definitely something to watch out for. And again, remember we mentioned, hey, the VIX wasn't down a whole lot and the market rallied, and we still have this inversion. Finviz Heat Map, a really nice balance day today, and Tesla was definitely the wild card. So again, like when you see the VIX futures term structure, it's getting better but not fully there yet. And then you also take into account that we just had a massive 2-day rally. I know what investors are going to do. You don't even have to tell me. I know what's going to happen. They were too scared to buy on Friday. They were too scared to buy yesterday. They were too scared to buy today. But as we start to hit just extremely overbought levels, that's usually where everyone, starts to get excited and buys. But I must say, in terms of just overall sentiment and what I'm hearing from investors and traders in my circles, I will say everyone is highly skeptical of this rally still. And I think there's a lot of investors that are still on the sidelines. Remember, we had like a 33-day sell-off in the market. And with positioning as light as it got, even if some investors go, hey, I think the probability of a Fed pivot went from a 0% chance to now, I think, a 20% chance. So for that reason, we got to add a little bit of exposure. We barely have any anymore. It's going to take time for that to occur. This could be something that, takes weeks to occur. So even if the market does have a pullback tomorrow or something of that nature, it's important to just stay level-headed and be like, okay, we just went up like 5 to 6% in 2 days. Am I going to freak out tomorrow if we go down like 1% or a 0.5%? No, I'm certainly not. But yeah, I don't want to be buying into like the 2-day rally at the same time. So yeah, Tesla was definitely the big wild card. Yesterday, Tesla was down over 8%. Everything else was positive. And we thought that was odd, right? We were like, this is just very strange. Something's going on here that we don't know about. And sure enough, we found out that the deal with Twitter is going through. We had a merger arbitrage trade on in Twitter. So we will go over that shortly. Sectors, we had a broad-based rally. And you can see top performers. We had ARK Genomics up 7.59%. ARK FinTech up 8.75%. Of course, the ARK Innovation ETF up big as well. KWeb was up 6.27%. I did notice some big strength in the international markets as well. And then for style factors, high beta was our best performer. And you can see size, which is the small caps, international value, also performed very well as well. And then in terms of trades, today I did a lot of cleanup. I definitely made some tactical errors in September. So today was me cleaning up some of those errors. And then, the market gods, they really just came through for me. I had this Twitter merger arbitrage trade on, and this one ended up being, like 150 or somewhere around that 150% winner. And this was able to make up for some of these errors that I hit. So I was very happy about that. I would say September was like some of the worst trading I've done in a long time at the tail end. And for me, so I'm like, got lucky there, dodged a bullet. Let's go through some of these bad trades. So Tesla, I closed these out. These were October 21st, 316.67 calls for 65 cents. I paid $14.25 for those. Luckily, it was just a one-star trade. I just put these have no shot of going in the money at this point. And this is the real takeaway and the learning lesson. This is the danger of buying high relative strength stocks in a -3 market environment. I was looking a lot at like this historical precedent. The 2020 fall sell-off was 15 sessions. The 2021 fall sell-off was 20 sessions. As we started to get to that number of days, I started allocating to the market even though my trend model was still at a -3. And I was looking for names showing relative strength. And basically what I ended up doing was I bought a couple of names while the trend model was still negative. So that was, not going in line with my process. And then also by buying the names that were showing relative strength, I basically bought some of the next stocks to get hit in the sell-off. So there's always like that adage, especially with like can slim traders and investors, like always go for the relative strength. But it also depends what market environment you're in. And that's why I say like this was just like a horrible trade. There's no reason why I should have done that. It was just kind of stupid. So I'm glad that I kind of got the redemption with Twitter. I closed out the remaining 50% of my UUP December 16th puts for 89 cents. I had the 30 strike. And yeah, I'd paid 48 cents for those. So that was a good trade. That was maybe like 80%, close to a double, whatever that is. And that one, the dollar had just gotten so overextended. So for me, it's like, the UUP trade, it's great, whatever. Made a couple bucks on that. Again, this is a 1-star trade as well. But yeah, that Tesla trade, the reason why that one bothers me is because that was such an easy trade to avoid. So that's when I say like, yeah, I feel like I traded poorly during that segment. That's really what it was. It's not like, for some of these, it was like just trades I never should have taken that I did. But it is what it is. You just kind of move on. So here, this was our really good trade. So we exited Twitter. We had the October 21st 40 strike calls for $12.40. I had paid $4.70 for those, and that was a 2-star trade, thank goodness. And this was the original expected value calculation that turned me bullish. So I entered this position, I believe it was when Twitter was at like $38 and change. And it took a while to play out, I must say. I was just kind of sitting with this position. But I assigned a 30% probability that the deal was going to go through. I actually thought it was a bit higher than that, actually. I was like, let me assume 30%. And target level 54.20 if the deal gets through. And then a stop out at 37.15 if the deal does not go through. And the expected value was, very positive. Really nice risk reward as well. So in that situation, when you do the expected value calculation, and it's so massively positive, it's almost like begging you to take the trade. Whereas again, for this Tesla trade, it was the exact opposite. There were so many red flags telling me don't take this trade. I ended up taking it. Same thing with this TLT, October 21st, 108 calls. Closes out for 66 cents. I paid $3.35. And I was looking back at the chart the day that I bought these. And I was like, why did I even do that? It was below the 5-day EMA. And it had just put in a red candle. And I think it was just like I really thought, the inflation data was going to slow and, we're going to get a rally in bonds and all this stuff. But even after we got that weak CPI report, I held on to my TLT exposures. So again, just kind of a lapse. And, I forgive myself for this because I think in most market environments, like when you get like 20 down days in a row or whatever it is, probably like 7 times out of 10, the market reverses at that point. But it's very important to know every situation in the market is organic. So you can never just rely on a pattern in that way. Like, yeah, this is just going to get better. Even if my process isn't really confirming, even if the asset and the price action currently just looks like trash, hey, this is what should happen next. You're kind of inferring the next move. That's really where you don't want to be in your trading. So I was glad to just, clear those off and move forward. So those were options trades. Let's take a look at the actual market. Let's see what we got. S&P 500, we've had 2 really nice days in the market, right? And now we are trading inside of this monthly value area. We're just a smidge below the 20-day SMA. Do I think the 20-day SMA is going to get tagged at some point? Absolutely. Keep in mind, though, we're a little bit extended away from this 5-day EMA. It pretty much lines up perfectly with a retest of this bottom of value here at 37.47. So yeah, tomorrow, if we end up trading down to 37.47, am I going to be like panicking and like screaming bloody murder? Nah, absolutely not. I think it's important just keep that 20-day SMA in mind. And also, now that we've broken into value, we have the monthly point of control right up here at 3902.75. I do think that's a realistic target because I do think there's a lot of investors that are still very, very underweight the market. Let's take a look here at our NASDAQ. The NASDAQ, this one is also trading down a smidge in the after hours. Same deal here. We just broke into value. Now, I know there's a lot of investors that they're like, oh my gosh, got to short this thing now. Again, like this 5-day EMA is right down here. Maybe you go on a 2-day basis for overbought, short it for like sort of like an intraday or like scalp trade. But I just think, for me, I'm playing this for the end of the year rally. So for me, it's like even if it pulls back to like the 5 EMA or retests the bottom of value, that's just kind of like, it's par for the course really when you're playing for like, a multi-week move or a multi-month move. Russell 2000, very nice candle here. We closed above the 20-day SMA for the Russell 2000. That looks pretty great. Our Dow Jones, you can see we're also trading inside of value. We're on the verge of testing that 20 SMA. And then the ARK Innovation ETF, which we are currently long. This one put in this nice double bottom pattern. And you can see I drew this trend line in, and we're pretty much pressing right up on that trend line, as well as the 20-day simple moving average. On the hourly chart, we do have a VPOC that is up at 41.85. That is the point of control from last week. And do I think we could tag that level? Absolutely. It is going to be dictated by and large by what Tesla does. I've actually been pretty impressed by the strength in the ARK Innovation ETF, despite Tesla being a bit weak over the past 2 days. I mean, yesterday was down over 8%. Today only bouncing 2.9%. But I definitely think it's going to be important to watch how the market deals with Tesla. I think the market's just kind of relieved that we've got some clarity on this Twitter thing. And you can see we ended up closing positive, so I think that's a pretty good thing. In terms of the VIX, where are we? VIX finished down 3.42%. Again, you can see put in a bit of a hammer candle, definitely worth watching. We want to see the VIX continue to cooperate and start to move convincingly below a 30 handle. And then check this out. Our dollar index is behaving very well. So there's a lot of investors, they're like, how could the market be rallying? And it's like the big problem was the dollar rallying. So the fact that the dollar is now pulling back, being a lot more cooperative, why can't we get a relief rally? Especially when positioning is so low. There's only 2 buttons every investor has. There's a buy button and a sell button. Once you've sold everything, then there's only 1 button. Then it's just the buy button. And I think that's the situation we got into over the past couple days. These bonds, keep watching these as well. These are our 10-year Treasury futures. We are also trading inside of value here. Definitely going to do some more scanning of the market just to see if there's any better looking opportunities. Again, I think if you are wondering, like, is the market going up or down? Like, how do I know? Maybe if I read my Twitter feed long enough, like, the answers will just come to me. That's not going to happen. I think it's best to just do scans overnight and just see, like, are my favorite setups appearing? The setups that have edge. And if they're appearing, then take those setups. But if they're not appearing, the setups that you trade, then don't take any risk. And that's how you let the market dictate how much risk that you're in and how much risk you're not in. This one looks pretty fantastic, Wolf. I'm already positioned in this name, but I think this one really stood out to me today. You can see Frey also. This one had a breakout. We mentioned this name. I believe it was either on yesterday's video or Friday. I forget. You can see Frey breaking out of value as well. Even some of these crypto names definitely worth watching. Like Hut 8 Mining. This one is breaking above the monthly value area. It's no joke right there. And then Coin. This was the biggest positive contributor to the ARK Innovation ETF today. Coin is also breaking out of value. So again, like if you trade these monthly value areas, you're a breakout trader, what are we seeing? We're seeing some more breakouts than we did over the past week or so. So I think that is a good thing. I think it's important. Just keep it simple out there. You don't need like your PhD in economics to navigate the market. All right, everyone. That being said, hope you all had a good session today. We will see you all tomorrow. Have a good night.